Today we will be discussing the best Vanguard index funds to invest in for passive income. Let's get into the video. Hi everyone, my name is Zach and welcome back to Finance Bro. So this video might be a little bit different than the normal videos we make, but it's something I want to go over. To be transparent, 80% of my investments are in long-term investments. Only 20% of my investments are in short-term investments or basically trading. So 80% of my investments are in index funds, ETFs, mutual funds, and a few select stocks that I believe in long term, like no matter what, I think they'll go up. And then about 20% of my investments are used in trading and the stocks that we talk about like in our videos. So these index funds are my bread and butter and I just have to share them with you. But before we talk about these index funds, I just want to remind you guys that we just launched 3 new courses on our new website, and we actually just put a free course on the website. It's a very mini course, it's like 10 minutes, and it shows you how to find hot penny stocks or hot stocks in general. But we will be giving you guys 20% off when you use code BRO at checkout. So if you guys want to utilize that 20% off, it's going to be closing tomorrow at 11:59 p.m. So make sure if you want a course to get it now, because you're not going to be able to get 20% off for long. And if you want 2 free stocks and you have not made an account with WeBull yet, go ahead and click the second link in the description and get all signed up. Alright, but with all that out of the way, let's get into our index funds. So in today's video, we're actually going to be going over ETFs that follow a market index. There is a difference between an index fund and an ETF, but ETFs basically have a lower barrier to entry and do the same things as index funds and have a lower expense ratio, which I'll go over later in the video. So the ETF is basically the index fund, but it's something that you could trade throughout the day instead of having to buy it and then waiting till the end of the day for it to execute. ETFs are just easier and basically the same thing at a lower cost. Alright guys, so the first ETF that we're going to be going over today is going to be VU. And this is probably the most popular ETF on the market at the moment because it follows the S&P 500 basically to a T, but it's with Vanguard, so they have the S&P 500 like name recognition as well as Vanguard, but basically it just follows the S&P 500 like to a T. And something really cool about these ETFs that Vanguard has is that their expense ratio is actually 0.03%. So basically, if you had a $1,000 investment, all you would be paying for the year would be 30 cents. And it's definitely going to net you a lot more than 30 cents. If you had a $1,000 investment, you're definitely going to get more than that. So basically, the expense ratio is very low compared to, say, an index fund, which this would be way more expensive by like a lot. So something else very notable about VU is that they have a 1.52% distribution yield. So basically, you're going to be getting a dividend of 1.52% for the year. That's not that much. If it was a $1,000 investment, that's going to be like, I don't know, $10.52. That I don't know if that math is right. So it's not going to be that much, but it is still something. So something to think about. And then if we look at the top 10 holdings of VU, it's going to be Apple. Pretty much all these ETFs are going to have Apple at the forefront, except for the emerging market fund. But yeah, Apple, Microsoft, Amazon, Facebook, Google. Google again. Oh, there's different classes of Google. And then Tesla, Berkshire Hathaway, JP Morgan, and Johnson & Johnson. So basically, these are really good. Sorry, I just got a YouTube comment. These are really good holdings to have in your account, and that is going to be 27% of the total ETF. And those 10 holdings are going to probably net them most of the gains that they're going to have. So as for how they have performed over the past year, 30% over the last year, but we've had a massive bull run. So really, if we look for their life, 14%. So if you had a $1,000 investment and over the life of this investment, it was giving you $140 per year, would you not want to invest in it? This is a very good ETF. Let's move on to the next one. We're going to have the VTI or Vanguard IDX fund. So basically, VTI covers the entire market. As you can see, if we look at VU, they have about 511 holdings because it's the S&P 500. If we look at VTI, they have 3,669 holdings. So basically, they try to buy the whole market. Like they want to get every sector, they want to get the best stock from every sector, and they are buying like every stock that they can. This has honestly done better than better than VU. VTI has done 35% this year, although over the life of the fund, it's only done 8.5%. So that is something to think about. It has better returns over the last year, but it has worse returns over the last over its life. So this is one that I hold in my account and I love it. It does have a 1.38% distribution yield, and also a 0.03% expense ratio. So this is something that I hold. I hold both VU and VTI. It's probably the bigger holdings in my long-term investment accounts. But all right, let's move on to VUG or VUG. Vanguard Growth Index Fund. So this is going to be your like growth, like this is going to do worse when the market's falling, and it's going to do better when the market is like going crazy. So it has the worst distribution yield, but we're not really worried about the dividends we're receiving because we're just going to be reinvesting. That's what I do. That's why I teach in my course. If you guys want to sign up for the course, link in bio or description. But so it does have a worse dividend yield, but I just reinvest the dividends. So I'm not really worried about it too much, and I want more growth out of this. So obviously it had 45% returns over the last year, and it's returned 11% over its life. So obviously VU has done the best over the life because it's following the best 500 companies. Even though it's done the worst out of the three this year. Their top holdings are going to be Apple, Microsoft, Amazon, just like the others, but they do hold Visa and NVIDIA, which NVIDIA is involved in AI, so this is why that's going to be a lot of growth over the next few years. And then also MasterCard, so it's just those are 45% of the top 10 holdings. So they're really looking for a lot of growth out of these companies, and I do see a lot of growth coming from these companies as well. But yeah, they do have a little bit higher net expense ratio. So it's like if you had a $10,000 investment in this fund, it would be $4 expense ratio for this fund versus like $3 for the VU or VTI. So it's not that much more, and it has a little bit less of a dividend yield, but with this fund, we're looking for more growth out of it. But yeah, that's going to be VUG. Oh yeah, and I didn't go over VTI's top 10 holdings, but it's basically the same thing as VU, but it just holds less weight because they have a lot more companies that they're looking at. All right, so this is going to be a diversification ETF. It's going to be a VWO, Vanguard Emerging Markets Stock Index Fund. So basically, this is for diversification. Its top 10 holdings include Alibaba, which I'm very bullish on. It has 5% of Alibaba. So if you want some exposure to Alibaba, but you're not too sure about it, this would be definitely a good ETF to get into. But there's going to be a lot of stocks in here that you don't know about. This is my lowest holding, but I hold it to diversify my portfolio. If the US is just tanking one day, but emerging markets aren't, I want to have a little bit of light at the end of the tunnel with this ETF doing better when my US ETFs aren't doing that well. But I don't hold much of this because I really believe in the US's ETFs. The thing about this one is it does have a higher expense ratio, but it's basically like if you had a $10,000 investment, you'd have to pay $10 to them versus having to pay you'd have to pay $4 or $3 for these other US ETFs. And there is no dividend, but really from this, it's just to diversify. So I'm not really looking for dividend income from this. If I want dividend income, I usually buy individual stocks, such as Verizon or Coca-Cola. But as for the last ETF we're going to be talking about, it's the Vanguard High Dividend Yield Index Fund. So I just have this one to also diversify. Because when a company is paying dividends, that means they are making a profit and they are giving those profits back to the customer. So that means the company will be doing well, in my opinion. They're making a profit. Those are the type of companies I like to invest in. Some of these other ones, like Tesla, doesn't pay a dividend, but it still will give you growth. With these ones, I know these are going to be steady. They might return less money, but at the end of the day, they are making a profit. I like to diversify like that. But it has like Chevron, AT&T, Verizon, Exxon. You're not going to see a lot of growth from this. It only had 19% in this huge bull year we've had. It's only done 8% over its life. But if you do reinvest your dividends, that percentage does come up. Basically, it's like 3%. You can just add that on to its returns because you're just going to be reinvesting it. And its expense ratio is 0.06%, so it's like paying $6 for a $10,000 investment. It's not that much. Mutual funds can get up there in expense ratio, and that's when it becomes a problem. But I also do hold mutual funds, so if you want a video on that, comment down below. But as for my overall thoughts on index funds or ETFs, I hold them as my biggest positions in my overall investing portfolio because I like to have steady growth throughout the year. While I do get more gains out of my short-term investing, there's a lot more risk involved and that could go south quick. So this is a very good way to make sure that you are getting, constant gains. But yeah, I really like ETFs for that reason. I want to remind you guys I'm not a financial advisor, so make sure that you guys do your own due diligence on these stocks. Don't invest in them just because I talked about them in this video. Make sure that you do your own research or talk to a financial advisor if you want advice on these. And now for comment of the day, y'all comment and I'll pick one of your comments for comment of the day. Today's comment of the day is coming from Marcos, and he said, "LOL, I'm not a kid. I turned 21 in a month." That's what I said. Is that your pickup line for chicks? You couldn't even get her a drink yet. Keep grinding. Thanks for the comment, Marcos. I'm not sure if you are roasting me or trying to encourage me. But yeah, I mean, I turned 21 in less than a month. If you think that makes me a kid, okay. But I have done a lot of research and know a lot more about the stock market than the average person. So, I don't know what you were trying to get at here, but I appreciate the encouragement at the end of that comment. But that's going to be it for today's video. If you did enjoy, please leave a like, comment, and subscribe as it really helps with the YouTube algorithm and it shows we're doing something right here. But my name is Zach and I'll see you in the next video.